What is stock? Stock is just partial ownership of a company. By owning shares of a company, you will indirectly benefit from the success of the company, either through its stock price appreciation or through dividends. For example, if a certain publicly traded company declares that each share of stock is eligible for 50 cents of dividend, then for every share you own, you will receive 50 cents. If you have 100 shares of this company, you will receive $50 periodically. Not all public companies pay a dividend though. The companies that pay a dividend are usually large and stable enough that they can afford to pay a dividend consistently on a regular schedule, be it monthly, quarterly, semi-annually, or annually. Banks, insurance companies, and utility companies are common examples of companies that pay a dividend consistently. This does not mean that companies that do not pay a dividend are struggling financially. It just means that these companies may still be in the growing phase and need to channel any profit made back into the business to help the company grow further instead of paying it out as dividends to shareholders. Most growth companies do not pay a dividend. Instead, the success of these companies will be reflected in the stock price appreciation. In general, the money that you could make from stock price appreciation of growth stocks is always more than the dividend that you could collect from dividend stocks. So just because growth stocks do not pay a dividend, it does not mean that you should only buy dividend stocks. In fact, if you intend to grow your money from $10 to $1 million in a short period of time, you should focus only on growth stocks at the early stage. It is only when your money has grown to a considerable size that you could diversify to dividend stocks for more stable passive income. For more details on how you can turn $10 to $1 million in 5 years as outlined in our other video, please click like and subscribe for regular updates. Now, back to our main topic. So what makes up the stock price and why does it fluctuate? A stock price consists of the following. Company's underlying financials. A company's ability to make money forms the basis of the stock price. When a private company decides to go public, it will have an initial public offering, or IPO. This means that a certain number of shares of a company will be available for the public to be traded on the designated stock exchange. Publicly traded companies usually report earnings on a quarterly basis. From these reports, analysts and investors will evaluate whether the current stock price is in line with the reported earnings. If actual earnings differ a lot from the estimated earnings, the stock price may either shoot up or drop substantially, depending on the situation. Companies' growth prospects. Many growth companies do not make a profit initially, but their stock prices continue to go up nevertheless. That is because investors see the potential growth prospects in them, and believe that eventually, they will become profitable companies. Just because a company is posting huge losses every quarter, don't write off the company just yet. If the reported losses are getting smaller and smaller in consecutive quarters, it actually means that the company is growing rapidly and may soon become profitable. In other cases, just the company's product or concept may be enough to drive the stock price up regardless of whether the company is profitable or not. As traders and investors, the important thing is to simply pay attention to the story behind the stocks that are rising in price rapidly. Any news, rumors, and accusations about a company will certainly affect its stock price, regardless of whether they are true or not. If there is a rumor of a potential takeover, the stock price of the company being bought will usually shoot up substantially. Conversely, if there is accusation of accounting irregularities in a certain company, the stock price will drop dramatically. Rumors and accusations usually affect the stock price for a very short period of time only. However, if there is any news about the fundamental business of a company and its revenue, you can be sure that this will immediately be reflected in the stock price, and it may not reverse course. So paying attention to news is very important. Imagination and emotions. Some people are either overly optimistic or overly pessimistic at times. These are all factored into stock price. Fear and greed will magnify a situation to a level that the stock price becomes detached from the underlying financial fundamentals of the company. So at certain times, a stock can either be ridiculously overpriced due to greed and rosy imagination of the company's future prospects, or ridiculously undervalued due to fear and pessimism. The smart traders and investors should remain calm in all situations and recognize it as an opportunity for profit instead. Overall sentiment of the market. This is like a headwind or tailwind for most stocks, depending on the situation. When the economy appears to be growing and the entire market is optimistic, most stocks go up regardless of their fundamentals. We call this a bull market. Conversely, when the overall market appears to be cautious and pessimistic, most stocks will drop regardless of fundamentals, even for undervalued stocks. We call this a bear market. The smart traders and investors will use this to their advantage and just go with the flow instead of fighting against the market. Supply and demand. All publicly traded companies have a preset number of shares available for trading on the market. When institutional investors, like fund managers, start accumulating shares of a company, the number of shares available on the market will decrease. We are not talking about a few shares purchased by your neighbor next door. We are talking about big institutions or investors with deep pockets who buy millions of shares at a time. This will likely push up the stock price depending on the number of shares being purchased and the shares available in the open market, known as the float. Conversely, when a large number of institutional investors start unloading shares of a stock, the stock price will undoubtedly drop. It is important to remember that the stock price does not magically change on its own. The reason stock price changes is because there is constant buying and selling of shares by different parties during trading hours. By understanding the driving forces behind the stock price, you will be able to make more informed trading decisions. Of course, what we have outlined is just the surface. There are more ways to accurately predict stock price movements. We will get deeper into it in other episodes. Thanks for watching. See you next time.